European equities have experienced an almost surreal beginning to 2015, with the market delivering nearly 20% in 3 months. The dominant catalyst to date has naturally been the announcement of quantitative easing by the European Central Bank. This additional support, at a time when liquidity has been withdrawn from other regions globally, coupled with renewed signs of life in the European economy, has resulted in a significant shift of assets into the European equity market. So after a return of this magnitude in such a short period of time, the question investors are asking is, where can the asset class go from here? After such a strong run, we believe it is only natural to see some periods of consolidation over the coming months. The strength of flows into the market since the beginning of the year has ensured that other concerns have been overlooked, and we believe that this is unsustainable. Similar to 2013 and 2014, we may experience some mid-year weakness as the euphoria which surrounded quantitative easing evaporates somewhat. This is a year of elections in Europe, and we have seen growth in the support for anti-austerity parties in most countries. To date, the market has been brushing off these concerns, particularly with regard to Greece. But this cannot be ignored forever if we see an escalation of the situation. This, coupled with heightened expectations of US rate hikes, leads us to believe volatility will increase again as we move through the year. Nevertheless, our key catalyst for the European market in 2015 remains earnings growth. Despite the performance of the market, earnings growth in Europe is actually only starting to materialise now, and we expect to see an acceleration as we move forward through the year, providing the market with the ultimate reason to move higher again. Our 3 themes identified at the beginning of the year remain broadly the same. Firstly, we have a preference for cyclical areas of the market. Although these areas have outperformed over the last number of months, we believe there is still plenty more to come. Investor positioning remains quite defensive, but we believe both the increased potential for earnings growth and valuation opportunities continue to favour more cyclical areas of the market. Stock specifics remain important, and investors who identify those individual investment cases with the ability to deliver greater earnings should be rewarded by the market. Secondly, the search for yield has reached new heights after quantitative easing. The number of bonds trading at negative yields has increased dramatically, forcing investors to consider other asset classes for income purposes. We believe equities will remain one of the highest yielding asset classes over the year ahead. However, we retain the view that focusing on income alone is not enough when seeking to benefit from the potential the European market has to offer this year. Investors need to focus on high-quality stocks that, in addition to offering a decent dividend income, can deliver earnings growth and ideally greater capital appreciation. Finally, as detailed already, despite our quite positive outlook for both the Eurozone and the asset class, volatility globally is likely to trend higher as we move through the year, and investors should be prepared for that.